India just unplugged from the global silver pricing system. Most people didn't notice. But if you've bought silver jewelry, invested in an ETF, or paid attention to festival season price spikes, this affects you. Because after this decision, prices moved so fast some people thought they were being scammed. They weren't. The system changed. A few months ago, India's regulator SEBI made a quiet rule change. Mutual funds and ETFs can no longer use COMEX prices, the global benchmark in New York and London. They must use domestic MCX prices instead. That sounds technical. It's not. Before this, India was plugged into the global pricing network. After this, it wasn't. And when you disconnect the world's largest silver buyer from the global benchmark, things move fast. India consumes about 25% of the world's silver every year. They love it. Let that sink in. One country, 1/4 of global demand. So if India changes how it values silver, that doesn't stay local. Yikes. It shifts pressure across the entire system. And almost immediately, it did. Premiums in India jumped. Dealers started reporting shortages. Physical silver became harder to source. Prices didn't drift upward. They spiked. Before, if silver got too expensive in India, traders could import cheaper silver from international markets. That kept prices in check. Global pricing acted like gravity. But once India stopped referencing COMEX and focused only on domestic pricing, gravity weakened. Prices started reacting purely to Indian supply and demand. And when demand is strong, especially during wedding and festival season, that can get intense. My mom buys silver jewelry every Diwali. Same bracelet. Same jeweler. Same weight. 2 years ago, 12,000 rupees. Last year, 15,000. 25% higher. She thought the jeweler was overcharging her. But he wasn't. He was reacting to upstream price pressure. And here's what happens when prices start jumping. People rush in. If you think silver will be more expensive next month, you buy now. That increases demand, which increases prices, which increases urgency. That feedback loop can move markets quickly. Here's the structural problem. Before this rule change, global traders could look at pricing differences between London, New York, and India to understand demand pressure. It was a signal. Now that signal is distorted. If India consumes 25% of global silver, and prices are moving independently, global traders just lost clean visibility on 1/4 of demand. That's not minor. That's structural. Commodity markets rely on transparency. When transparency drops, volatility rises. Right now, this could stabilize. Premiums could normalize. Markets could adjust. But here's the bigger question: what if other countries copy this? If China, the second largest silver consumer, also decouples from global benchmarks, now you don't have one global silver market. You have regional pricing zones. Fragmented markets. Less transparency. More volatility. That's when you get violent swings. Sudden shortages. Price spikes nobody can fully explain. Because traders are operating without full information. And this isn't just silver. This is a test case. Should countries depend on global benchmarks? Or create domestic pricing systems? If India's model protects consumers or stabilizes markets, others may follow. If it creates chaos, they won't. Either way, this is bigger than jewelry prices. This is about how commodities are priced worldwide. Oil, gold, copper, food. If major buyers fragment away from global benchmarks, the entire structure of commodity trading changes. We're watching that possibility unfold in real time. India just disconnected from the global silver pricing anchor. That reduced transparency. Reduced transparency increases volatility. And volatility eventually forces repricing. The only question is how big. So here's what I want to know: is this smart financial independence? Or the beginning of commodity market fragmentation? Because if fragmentation spreads, what happened to silver could happen elsewhere. And next time, it won't just be about a bracelet.